Just when everybody least expected it, we're going through the biggest sale of the year. I'm not talking about Amazon Prime Day or the back to school sales or tax free weekend. What I'm talking about is the momentary pullback we're seeing in the stock and bond markets. I don't want this news to be a shock to you, though. Just like any good sale, this will likely be over before you even realize it. I'm very confident that a few of you are feeling uneasy right now because of the seemingly endless messages being launched in your direction about how dire the next few days, weeks, or months will be. But I also know that the majority of you probably didn't even realize anything was going on in the world until you're watching this video. And for those of you that are in that boat, congratulations. We don't want you to be worrying and freaking out based on headlines because ultimately we can't control it. All we can do is control our actions and our emotions and our reactions. And that's what I want to talk to you about today. The truth is, our world is filled with constant noise, and finding an opportunity to silence that noise to absorb reality is becoming increasingly difficult. As a result, I want to share with you a few important truths that I hope can help set the record straight going forward and give you more confidence and hope for the next few days, weeks, and months. So let's start with the current sale in the markets. The truth is, unexpected events happen all the time. And despite this, media pundits constantly and foolishly express certainty about the future of the market, the economy, and the world. The problem, though, with forecasters like this is they fall into one of two categories: forecasters who don't know and those who don't know that they don't know. The phrase, "I didn't see that coming," should be the theme of our investment experiences, but it shouldn't be a negative thing. The historical data proves that often the unexpected events that cause us the most short term indigestion are the same events that bring the patient investor the most long term satisfaction. For instance, the only thing more surprising than the first pandemic we had in a century back in 2020 was the market's response to that pandemic. As the world looked toward an economic shutdown in March of 2020, the quote forecasters predicted a depression level decline, but instead the market rallied hard and posted a return of over 18% for 2020 and over 28% in 2021. Nobody, and I mean nobody, saw that coming. We could say the same about the Russian invasion of Ukraine in early 2022, the failure of Silicon Valley Bank in 2023, and even the attempted assassination of former President Trump just a few short weeks ago. This is just a sampling of events from the past few years, and we could go event by event for the past decade or even the past 100 years. We would probably stop watching this video after the first 15 seconds of me going through all that. So, in short, the lesson to learn from this is there will always be surprises, but we shouldn't be surprised by the fact that there are surprises. The best way to be prepared for this is to expect them with a positive attitude, eagerly anticipating that the outcome might just surprise you too. And with that, make sure we have a plan and a strategy in place for how to address these situations when they do come up. So, what does this mean for you? That's the most important question right now, and that's what I want to spend the rest of our time talking about. To answer that question, as history has proven, or how you answer that question, as history has proven, has the potential to be the step that either sets your financial journey up for continued success or could sideline all the hard work you've put in for your future. For all investors at this point in time, momentary sales in the public markets, like the pullback we're going through right now, should be viewed as little gifts given to us to make strategic planning changes around taxes or diversification. If you have a large amount of pre-tax dollars in retirement accounts and have extra money of savings in the bank, we need to seriously consider some Roth conversions to convert some of that pre-tax money into Roth after-tax accounts to grow tax-free for the future. This reduces your future tax liabilities and can even create a more positive generational impact for any money you pass down to your future generations. If you have large taxable investment accounts, they've probably gotten a little bit lopsided from growth over the past couple of years. Now, we do routinely process rebalancing inside of accounts to make sure targets are on track, but sometimes things run up really, really fast. Like in the past few months, a lot of different asset classes have skyrocketed, and that means we have a little bit of a lopsided diversification. Making changes to realign these portfolios to proper diversification is important so we don't really feel or bear the brunt of pullbacks like this going forward. For those that are accumulating right now for retirement and you're still years away from potentially using that money, maybe even it's just 5 years away, and if you're sitting on a lot of cash in money market funds, CDs, or savings accounts, stocks are currently on sale. And we shouldn't delay to put that money into the market to compound your growth or get the opportunity to compound your growth going forward. We know historically that 75% of years, the stock market ends positive with growth. So if we know that is a sure thing, we should definitely look for those opportunities to place money in the markets and actually get that compounded growth going forward. If you're in retirement and living on a fixed income, though, without a lot of extra savings in the bank, I would say the focus right now is to tighten our belts, avoid extra luxury spending, and focus more on the necessities. Let's take the next few weeks or months as things settle out to really hone in on what's required and what's necessary for life, and maybe delay that vacation or delay that purchase that we're considering doing that could have a drastic impact on taking money out of our portfolios. Overall, though, I want to encourage you that we have been here before. We will be here again, and we're going to go through this on a regular basis. The process of investing is just intentionally allocating our money towards certain assets or asset classes to help us compound that money to create more opportunity over time. There is inherent risk with that, but we know that those who take a little bit of risk typically get a lot more reward. So with that, I want to encourage you that we are fully aware of what's going on. We're paying attention to it. And from our perspective, reviewing client accounts and reviewing client situations with the information we have, we see that everything is going to be just fine over time. Now, that being said, if there has been something that's changed in your life or changed in your financial situation over the past few months or even over the past year that we don't know about, I would love to learn that right now, because I can only give the best advice based on information that I have for you and your personal financial situation. So if we don't have that information, we'd love to know that and schedule some time to chat in the next few weeks or couple months so we can make sure your plan is on track going forward. So if you do have any specific questions, though, about what's happening in the markets or what's going on, reach out to us and let us know. We view this as just a momentary blip, and it's going to be just fine for the long-term investor. And when I say long-term investor, I don't mean those that have 40 years to grow for retirement. Yes, that's part of that, but I also mean those who are in retirement, living off of portfolios. Don't forget that just because stocks might be in a temporary decline right now, we have a potential rate cut coming up from the Fed. Based on everything that's come up in the past few weeks and even past week and a half, it looks like we might be getting our first interest rate cut on the federal funds rate coming up in September. As soon as those rates cut, we expect bond valuations, like the value of the bonds in portfolios for those in retirement or those that have more conservative portfolios than growth investors, those bond valuations should go up, because as bond returns have gone up over the past few years, the constant turnover of bonds inside the funds inside of our portfolios has been buying bonds with higher yields. And as rates go down, that means new bonds will have lower yields, and therefore the ones we already own with a higher yield increase in value. So all of this is part of the plan. All this is part of the strategy to make sure that your financial security is on track and is in the right place. But if you have questions, please don't hesitate to reach out. I'd be more than happy to schedule some time and chat in the next few weeks. And I hope that you guys are having a great week, and I look forward to chatting with you soon. Have a great day.